Welcome everyone. Today we have with us Mihir Patki sir. Mihir Patki sir began his career in Deloitte where he did his internship. Subsequently, he worked with Bank of America, Merrill Lynch with Global Markets Finance team. Post BAML, he worked at JM Financial as a derivative trader. From 2013 to 2020, he worked at CVK Advisors. After that, in 2020, he co-founded Multipie. I am sure most of you are also part of Multipie and using it. And his educational qualifications are CFA, CA, MBA, FRM from the University of Oxford. Thanks for being on this show, sir.
No, Jay, thank you for having me. It's a real pleasure to talk with you and your audience. And I'm delighted to be here.
Welcome, sir. Welcome, sir. So can I start asking you the questions?
Yeah, sure. Go ahead, please.
Yes, sir. The first question is, how did you get interested in this CFA, and MBA? What intrigued you to do these education qualifications? Why did you become a CA? Why did you become a CFA? And after that, MBA? What intrigued you to do all these educations?
So, CA was, call it destiny, fate, luck, whatever. So I scored very, very poor in my 10th standard and didn't have a choice. Wanted to take up science, but obviously at that level of grades, I was not going to get an admission anywhere. So I had to take up commerce. Once I took up commerce, CA was a logical choice. My parents are chartered accountants, and I had to do something which is academically challenging. My parents have been rankers throughout. Unfortunately, I've never had a rank anywhere. So CA became like the natural choice. So, that's how I landed in commerce and CA. Now, in the earlier days, people used to do these 3 degrees, CA, CS, ICWA. Right? And people would say the curriculum is overlapping. If you're doing one thing, just you'll get another degree just like that. I didn't want to, go down that road. That trend shifted to CA, CFA, FRM because again, there was a lot of overlap. CFA was also actually a funny story. So after I passed my CA, a few friends were doing CFA. And in those days, CFA exams used to not happen in India. So like my friends used to say, "Chal na CFA karte saath mein, let's go to Dubai and give the exam." So it became an excuse for going on a holiday. And that's how I started with CFA and eventually got serious into it and completed it.
Okay. So before when you were doing this CFA and CA, there was a natural interest towards stock market, or when did the interest in stock market begin?
So I started my articleship in 2005, and I used to get a stipend of 5,000 rupees back.
So the articleship was when you were doing CA or CFA?
So the articleship is part of the CA course.
Got it.
Like 3 years is what is mandated. Okay. So I did my BCom and my articleship alongside. So you attend college in the morning for a few hours, then go to office.
Got it.
And we used to make a stipend, 5,000 rupees in those days was a big sum. Right? And that time my objective was, okay, camera phones were new that time. Okay? And a camera phone would cost like 20,000 rupees. This is those Nokia 3660 kind of phones. So I used to calculate saying, okay, 4 months and I'll be able to buy my mobile phone. Like, that's great, right? My parents, who have been very disciplined investors, investing passively, but with a lot of discipline. They said, okay, you are earning at a young age, you should save something. Right? So my dad literally forced me to invest 500 rupees in an SIP. So that's how my journey started.
Okay, so out of those 5,000, you invested 10% in the SIP.
Yeah. And that too, after a lot of negotiation, my father was saying you should save more. I said, nay, 500 is enough. Because these were not days when you would be able to monitor your mutual fund portfolios like we can do today. You pull up your phone, you are able to see what's happening. This is, you get a physical form, you sign it, you send a mandate to the bank for the SIP. The physical statement will come to you maybe 1 month later. Right? So monitoring what is happening there used to be very difficult.
So it was all in physical forms, right?
Everything in physical form. And there were 2 mutual funds then. I think one was Franklin, one was Reliance, 2 AMCs, who allowed you withdrawal from ATMs. So I could redeem my mutual fund in the form of cash in ATMs. It was not a product that lasted very long. So I said, okay, let me invest in those because at least I have, access to my money. So that is how I used to think that time. But, that's how the journey started.
Great, sir. And when you were doing the articleships, what did you learn from those articleships and the various jobs that you did after the articleship? Like you worked in JM Financials and CVK Advisors. What were your learnings from those jobs and internships, etc., etc.?
So for my articleship, I used to work in audit. So I think the biggest thing that I learned there was reading financial statements.
Got it.
However, in those days, what used to happen was, as an auditor, you are focused on a lot of compliances. You tend to ignore the commercial aspects of
Can you please elaborate on the topic of auditor for the viewers? Like what is the purposes of auditors are and how he shapes the company?
Sure. So like every company has its books of accounts. Like all companies are mandated to undergo an audit as per the Companies Act. Now,
Correct.
auditor is nothing but a chartered accountant or a chartered accountancy firm that is going through your books of accounts and commenting whether the books of accounts presents a true and fair picture.
Got it.
So it's just
cross-checking.
Yeah, it's cross-checking. It's another set of eyeballs, because you as a shareholder, when you are invested in a company, you don't just want to take somebody's word for granted. You need a separate set of independent eyeballs on it. And that's what an auditor does.
Got it.
So now audit has a lot of standards, lot of prescribed methods, because standardization is important. Without that, it's just an opinion, like, it becomes very subjective. So when I was doing audit, most of the energies used to be focused on compliances with those standards. So while I learned how to read balance sheets, it was more from a compliance angle, not from a commercial angle.
Got it. Right. Like from a auditor's angle and not an investor's angle.
Yes, exactly. Yeah. And we used to feel very proud saying that, oh, I found some mistake in the TDS reconciliation. So, like we used to give ourselves a pat on the back. It's only much later in life you realize that, hey, that wasn't really material. So that's what I did at Deloitte. With Merrill Lynch, I used to work in the global markets finance team. So learned a lot about structured products and exotics over there. That was a very good learning. And that is when I was doing my CFA and FRM, really helped in that. With JM, I was working on the prop trading desk, trading derivatives.
But what are derivatives for the viewers?
Yeah. So, derivatives are financial products. So you have something like a cash underlying, which is a stock. Right? You buy a stock. Like if the stock is worth 100 rupees, you put in your 100 rupees and you get the stock. Stock goes to 120, you make 20 rupees. A future is a form of a derivative. You can use it to bet on a stock. For example, maybe bet is the wrong word here, but you can use it to emulate the movement of the stock.
Okay, so the future of the company's value will depend on the current price of that share, right?
No, so see, there's a share which is trading at 100 rupees. I have one option that I buy the share at 100 rupees. If it goes down to 80, I incur a 20 rupee loss. If it goes to 120, I incur a 20 rupee profit. Okay. But to buy that, I need to put in 100 rupees.
Correct.
A future is just a contract with this 100 rupee share as the underlying. So if I buy the future today, I don't have to put up 100 rupees. I have to just put up the margin, which is much lesser than 100. Okay. And if the stock goes to 20, I make a profit of 20. Okay. So futures are leveraged. They emulate the movement of the underlying stock, but at lesser margin, which means your profits are magnified, but your losses are also magnified.
Got it. So the value of the future will depend on the value of the stock, right?
Yes. And generally, it's a function of interest rates as well, which plays a very small part. For example, you could buy a share today at 100 rupees and you could enter into a futures contract. So I can enter into a contract with you, which says that, hey, Jay, I will sell you one Reliance share on, say, the last Thursday of January. Right? Sure. Now, if I have entered into that contract with you, I will buy the Reliance stock in the market. I'll keep it in my DP. Right? On the day of delivery, I'll honor the future contract by giving you that share. So what is my cost here? The interest cost that I will incur to, warehouse that stock in my account. So the interest rates also affect the spread between the cash and the future. And what we used to do on the prop trading desk was play between this spread. So we would buy the stock and sell the future. So buy the stock at 100, sell the future at, say, 101 or so. And at expiry, they would converge. So once you have a hedged position, cash as well as future, you don't care whether it goes to 80 or goes to 120, because in the end they are going to converge. You just captured the 1 rupee spread.
Got it. And so one more question that I have is that when you were doing these when you were doing the CFA and CFA, what did you learn other than investing that has helped you shape your current investment styles? Like what lessons did you learn other than investing?
You mean from the curriculum?
Yeah, curriculum.
So, to be very honest, I feel no curriculum can teach you investing. So what I learned during CFA was, of course, all technical stuff, like pricing various instruments, how to read financial statements, how to look at a particular sector, etc. But nothing teaches you like experience. Like, you can't just do a CA, CFA, MBA, whatever, and then expect that you become a good investor.
Got it.
It's only when you work practically, when you understand people more than you understand numbers. I think that's what makes a good investor.
Got it. So the degrees that you took that taught you about technical stuff, and the hands-on that you did were in your jobs, right?
So all the jobs that I did in the past actually had very little to do with the way I invest. For example, at JM, I was a derivatives trader where transactions happen in a matter of microseconds. Right? But I never trade on my own books. Like, okay. I don't do any futures or options myself. Right? I just invest for the long term. Right? Just look at a good business, buy it, forget it. That's been my style. So didn't really apply anything that I had learned on the job in my investing style. That just got developed independently.
Okay. Got it, sir. And then in 2020, you started the Multipie. You co-founded the Multipie. What was the purpose behind starting this community, sir?
That's a great question, and it's a topic I love talking about. So there's a story behind it. So it was March 2020. One of my very close friends from Oxford had come down to Bombay, and Sandeep, who is my co-founder at Multipie. So me, Sandeep, and his friend were discussing our portfolios. We sat down saying that, okay, there's going to be a lot of cases. Okay, the market is going to fall. Something bad may happen in Yes Bank. So all these shocks are going to come and the market is going to go down. But that time we didn't know the intensity of COVID. We used to think that, okay, once the temperature rises, the virus will be killed. That is what used to be happening in those days.
This was when, sir? February 2020?
Yeah, March 2020.
Okay, got it. Right? When there wasn't that much cases, right?
Yeah, not that much at all. So he said, okay, market's going to go down. And after that, it will pick up because, it's not going to be much. By May, all this COVID will be over. So we discussed all of that. None of us acted on anything in that. Okay. So we just had lunch, forgot about that conversation. Then came the great crash in March 2020. Our conversation started increasing, saying that, yeah, we discussed this, but we did not implement it. Right? Now what? Okay. Then those conversations started happening every day. Hey, what are you doing in your portfolio? I think, we should buy some consumption stocks because, that's really resilient. And it's a great opportunity. You're getting stuff at discount, but we should exit some REITs because, they may not perform. Right? So those conversations started increasing. Then we realized that despite spending years in the capital markets, none of us is an expert. Frankly, nobody can be an expert at investing because the field is that way. Someone may know better than us in chemicals. We may know better than someone else in banking because banking and finance is where we have worked throughout.
Core expertise.
Yeah. So we started speaking with our friends in the industry, right, who are CFOs, CEOs of various organizations, just to understand what exactly is going to happen. Okay. Because there's so much of uncertainty. Then we realized they are learning tidbits from us. We are learning tidbits from them. Then this whole realization came that investing is like a jigsaw puzzle. Several people are those jigsaw puzzle pieces which fit in together and you see the whole picture. One or two people can never get the complete picture. So that is where the idea of community was born. And then Raj, who has been Sandeep's old colleague from Merrill Lynch. So three of us worked together at different points of time. He called one day saying that, hey, I'm shifting to India from Hong Kong and let's build something. And let's build something which will outlast us. And let's build a very, very resilient business which will survive decades. And that's how the idea of Multipie came. And here we are. We just started.
And I think everyone who is watching this must be using the Multipie app. And the feature that separates us from the other app is the portfolio tracking app, that you can upload your portfolio up to the Multipie app. So how did you get this idea? Because this is the unique idea that I think nobody has implemented till date.
So, when we were having these conversations, all of this goes back to March 2020. We thought there should be a more efficient way of having these conversations. For example, if I would ask Sandeep about a particular stock, say Kotak Bank, right? He would have some superficial view, and then he would say, okay, I don't hold the stock here, I don't know. Right? But if I would ask him about a particular stock that he holds and is one of his top holdings, he would tell me inside out of the company.
Got it.
What's happening in what board meeting, like what's his forecast for revenue, just about everything. Then we realized that, okay, Sandeep is the guy to speak about X stock, but maybe Rahul is the guy to speak about Y stock, and Jay is the person to speak about Z stock. Typically what happens is you would put it out on social media or a WhatsApp or Telegram group, hey, what do you guys think about this stock? You will get a set of opinions, and the probability of those opinions being right or wrong is 50%. I mean, it's very binary. Right? It's like either you take an action on a stock or you don't. Right? But those opinions are not very valuable unless they are coming from someone who has skin in the game. So that was one of the core ideas. Right? Then we started adding layers on top. Like, Jay, if we were to discuss our portfolios, we are never going to discuss what's the size of my portfolio or how much money I have got in a particular stock.
But we will discuss the names that we have in the portfolio.
Yes. And that too, we'll never discuss the names wherein I have a 1% holding.
Correct.
Time pass ke liye kuch leke rakh diya hai.
We will discuss the top 5 or 3 holdings.
Correct. Basically. Correct. So that became the second layer, that, hey, let's show asset allocations, let's show top holdings, and let's show, like, if you're looking at a stock, who else holds the stock, so that you can have focused conversations. So our priority was to reduce all the noise and provide quality. So that became the backbone of the idea.
Got it. And this idea was also pretty great, that when you, in the Multipie app, when you go to a particular stocks page, you can see that how many people hold that company in their portfolio, and hence you can directly ask them questions like what was the recent updates in the company, what are the current capexes going on. This is also a pretty great feature that I like Multipie of.
We focus on the why. So like we run a hashtag called question the why. It's very easy to ask, hey, is this stock good or should I buy this stock?
Correct.
Right? That will get you a yes no answer, and that has no value. But if I ask you, why did you buy this stock? What happens is it kicks off a very high quality conversation based on which you will also learn and I will also learn.
Correct. Because you will revise what led me to buy that company. You will revisit the company's presentations, annual report. And then you will figure out that these were the reasons that I bought the company, and then you will tell that person.
Yeah. And then you start making mental notes that, okay, it appears that, these are the top 3 reasons or the top 3 variables to look at while investing in any company. Right? Then you start building your own thesis and you get better at investing.
Got it, sir. And what was your learnings building this Multipie? Because there must be many problems building the Multipie app. And what did you learn building that?
Learnings can be classified in 2 buckets. One is on the, I'll say, technical or product side. So all 3 co-founders, we come with backgrounds in finance.
Yes, right? Nobody has tech backgrounds.
Nobody has a tech background. So a lot of learnings on there, how tech really works. Right? In terms of, how to choose a tech stack, how to optimize things, how to manage a project. And we have a great team who's been very supportive. And in fact, we've learned a lot from them. The other set of learnings is more on the investing style side. Right? There's just like, the amount of insights that we have got from the Multipie community is just fabulous. Like there are people who are doing deep analysis of balance sheets and coming out with red flags. For example, there's a very active community member called Mukesh. Yeah. See, he's popular, right?
Yeah, he's popular.
Everyone knows him.
Everyone knows him, and he's putting so much valuable content. Like nobody can spot such a red flags in a company that Mukesh sir finds out.
Right.
And I think he's not active on Twitter, but he's active on Multipie, hence people go there.
So these are just simple things. that the first thing you can do if you want to just glance through an annual report is just check remuneration given to the promoters, or related party transactions.
Correct.
Now, you can read a book, you can go through thousands of pages, and like you will know at the back of your mind that this is a variable to be checked. But when you see someone doing it practically in a matter of 2 minutes, then you realize that, oh, this is easy, I should be doing this.
I can also do it.
Right?
Yes, correct.
So, a lot of learnings on those sides.
Correct. And what were your learnings in building a team for Multipie? Like you mentioned that none of the co-founders were on the tech side, all were on the finance side. How did you build a team that was pretty great on tech, building a tech for Multipie?
So I think patience is one word I would like to use here.
Got it.
We were looking for a tech team for several months actually. We waited for we waited to find the right person, right? And we were lucky enough to get a great tech team, right? The biggest learning there is that the attitude of the team matters much more than the technical skills, right? Because you have to hustle, right? There are a lot of unstructured problems that are thrown at you. The way you approach those, that matters more than your ability to solve the problem itself. If you're approaching it consistently with discipline, it will get solved. So our tech team largely had no idea about what investing is.
Got it. So they had no background of finance and you had no background of tech.
Yeah. So it was learning for both both the members. Right. So starting from what is a direct mutual fund, what is a regular mutual fund, right? So going to what's the stock, how do you calculate an IRR, right?
Correct.
So how do you bucket like things between debt, equity, and gold? Right? So if there's an ETF, is it a mutual fund? Is it a stock? Right? All of those things we built out with the tech team, and it was phenomenal learning from both sides.
Correct, sir. And now, as you mentioned that in the previous question, that you are an investor that you bet on the long-term companies. Like if you spot a good idea, you invest for long term. Can you elaborate on your investing style philosophy more on that?
So I think I am too small an investor to have my own philosophy or anything branded like that. But I'm a lazy investor.
Okay.
You can check out my portfolio on Multipie. You will see most large caps over there, with the exception of 1 or 2 mid caps that I believe in. Largely, you will see my portfolio is skewed towards banking and finance because that's an area that I understand the most. So the way I have invested is my SIPs are ongoing. I have never stopped an SIP ever in my life. Like, I mean, I may have stopped, but just because I switched to something else. I've always increased what I have invested in SIPs. On the equity side, I will just buy these large, very well governed, governance is of prime importance to me. Very well governed companies, and just forget about it.
Okay. So basically, your main priority is on the corporate governance side. And while you're studying those companies, you never stop your SIPs of mutual fund that are going on.
Yeah, I run them as 2 separate buckets. So when somebody is doing all the hard work for you at the mutual fund, right, you have the fund manager's expertise available to you for free, right? For a very, very small
fee. That's 0.1% or 0.3%.
Yeah, and on a divisible amount. That's the beauty of it.
Correct.
Right? I mean, I can have a fund manager working to manage my 500 rupees also.
Correct.
Yeah. So I run those 2 as completely separate buckets.
Got it. And sir, while you have worked for so many years in this finance field, there may be many mistakes that you did in your investing journey. Can you talk on those? And what were your learnings from those mistakes?
So several mistakes. If I begin listing them out, this podcast will go for a very long time. But let me give you a few examples. So when I was doing my articleship, everybody is really excited about the fact that, hey, I have cleared my CA Inter and I'm working with a Big 4. So I understand balance sheets better than others. That used to be an illusion we used to be in. And people would also, dabble in stocks because everybody has some stipend. Everyone, like, it's a thrill. So like today, people dabble in crypto or NFTs. Stocks used to be that thing back then. Okay. So some friends said, okay, there's this stock in the metal space and it's trading at 40 rupees, but I know the promoter and he's told me it will go to 100. So if the promoter is saying it will go to 100, तो जाना ही है. So why are you thinking? So I invested 1 or 2 months stipend in that stock.
Okay.
From 40 rupees, it fell down to 10 rupees. Okay, in a matter of few months.
So massive wealth destructor.
A massive wealth destruction. Fortunately, see, at the beginning of your investing journey,
you don't have much of capital also.
Exactly. So you can afford to make mistakes there. So I'm glad those mistakes happened then. But the joke is that eventually the share touched 100. Because what the promoter did when it reached 10 was, he did a capital consolidation. So 10 shares were clubbed into one. So while the price became 100,
but the value was
became
same.
110. Yeah.
Okay, got it.
And then we had this joke with friends. कि देखो मैंने बोला था 100 जाएगा, तो गलत नहीं है.
So the quantity was reduced, but the value was same.
Yeah. Okay. So the learning here was, despite all of that knowledge, being a chartered accountant, knowing how to read the balance sheet, I never read the balance sheet of this company. In fact, even today, I don't know. So the company is delisted now, or I think the name's changed. I don't know whether it was a metal trader or a metal manufacturer. So what?
So you had blind trust in that friend.
It's not just trust; it's that element of thrill.
Okay.
And it's also herd mentality. I don't want to miss the bus.
That is happening in crypto, right? Currently, everyone is doing that. So you also go in the mental herd.
Yeah, so today, FOMO is a very well-known word. Back in 2005, FOMO used to exist, but the word didn't exist. so that was FOMO. So, a big mistake that despite having all the knowledge, did not apply it. I never thought that I should apply it. Because a promoter ne bol diya jayega, that used to be the thought. That's why I said investing is more about understanding people and psychology than about the numbers itself. Like understanding numbers is like a commodity. Everybody can do it. Like there are free courses online. Other mistakes that I did probably was not invest enough. So, like in my SIPs, like I said, I would invest 500 rupees. But in this thrill, I invested my entire 5,000 rupees stipend. In fact, 2 months of stipend.
In the SIPs?
So in SIPs, I would put 500.
Okay. In the stock, you put two months.
I put 2 months of. So so all of this just happens because you are going with the flow. You have FOMO, and position sizing is something that I learned, by incurring that loss. So this was at the early days of my career. More recently, maybe just 1 or 2 years back, one of the biggest performers in my portfolio, Dr. Lal Pathlabs. So I sold it. So I had bought it at a PE of maybe.
And so one more thing, none of these stocks mentioned in this podcast are investment advice, right? And
of course,
correct. We both aren't SEBI registered. Continue, sir.
Yeah. So this is more of an anecdote and not an advice. So Dr. Lal Pathlabs was a stock with a very large position in my portfolio. I had bought it at a PE of about 60 or so. So when the PE reached about 100, I said, I'm a little old school value investor kind of. 100 ke upar 100 PE is like too much. I'm
बहुत बढ़ गया अभी.
बहुत बढ़ गया. I tried to time it saying abhi to niche aayega, so let me sell it and I'll buy it back again, so I'll make a quick buck.
Okay. So how did you what can you repeat that thing?
Yeah. So what I thought was, let me sell off the stock. Yeah, because it's it's at a high. The PE is also high. The price is also
and then when it will recorrect, you will buy again.
I'll buy it back.
Got it.
So that's what I thought I would do with a stock that I fundamentally believed in and was a large part of my portfolio. Because you have to take a call when to sell your winners, and that's really difficult. So I sold a stock. The price that time when I sold was probably around 2,000 rupees.
So you sold all of your holding?
I sold all of my holding.
Okay, got it.
Right? Because this was the rally after COVID. And that rally was like, it happened with great velocity. So I said, okay, let me try and make a quick buck. Sold it at 2,000. Stock went to 4,000. Now it is finally correcting in terms of PE and price. So I said, okay, let me now evaluate whether I should get back into the stock. But the lesson here for me was, when I'm following a particular approach, I shouldn't be changing it just because something is happening in the market and other people are doing it. So I shouldn't fall prey to it. And despite all of these years of experience, I still ended up doing this like a year and a half, 2 years ago. So, again, that's why investing is all about psychology and discipline. rather than about numbers.
Got it. So the first learning from your first mistake was that never follow the herd mentality and get into the FOMO. And the second one was don't focus on the market, focus on the company that you have bought and the thesis for it, right?
Yeah. And rather the lesson here is don't sell your winners. Like you can either be a trader or an investor. Don't try to be both.
Correct. You're changing your style frequently.
Yeah.
Correct. So, and so the ending question of mine is, what advice would you give for the beginners who are getting into investing?
So I think the simplest advice is just to begin investing. We are very fortunate today that we can invest online in index funds with denominations as low as 100 rupees.
And that too in less than 5 minutes, right?
Yes, correct. So
just the KYC takes a little bit 1-2 days. After that, you can buy the mutual fund in very less time.
Yeah, and KYC is a one-time thing, right?
Correct.
So you just have to do it for the first time. Right? So just begin investing is an advice I would give. It's very easy to fall prey to FOMO or trends, etc. And you have that urge that, okay, let me try this. My money is going to double overnight. Right? You need to satisfy that urge. Otherwise, if you don't do it, it's going to build up and you are going to blow it sometime. So have a small allocation towards thrill, maybe 1-2% of your portfolio. So it's like having a cheat day when you are dieting. Like one cheat day is fine. Don't make it cheat days. Similarly, in investing, have a 1-2% thrill allocation. Also, what I would say is don't fall for things like, how do I identify the next multi-bagger? Right?
The next HDFC.
Yeah. So focus on, just having a disciplined approach, which is just invest in index funds and forget about it. Try reading about stocks and forming your own view on why that stock could be a multi-bagger, rather than just look at, hey, this is going to be the next multi-bagger, that is going to be the next multi-bagger because 10 people have said it. So let me put little money everywhere, right? So you are just robbing your money of the opportunity to earn better returns by spraying it around everywhere. So don't fall for the popular narratives. Try to ask yourself the question why you are investing your hard-earned money. And if you are able to answer yourself on that and you are satisfied with the answer, that's when you go ahead and invest. Like the why can't be because 10 people are buying.
Got it.
The why can be because, okay, 10 people who are very knowledgeable are buying and they have given these reasons. Right? And I think I agree with this particular reason.
Got it. So basically, first of all, start investing, and then the second advice is start studying yourself. Like, don't go on the advice of some other people who have said it. Read yourself what is actually happening in the company, and then form your own conviction in.
Yeah. So when you start watching the Netflix series, you read a review, right? So before ordering food, you will check out the rating and read reviews on Zomato, correct?
Before ordering any clothes or before ordering any, you check the reviews on Amazon, Flipkart, etc.
Yeah, you wouldn't even buy a book which costs less than 500 rupees without reading reviews.
Correct. Right? If it doesn't have the printing quality if it isn't that great in the reviews, if they say, you won't buy that book.
Yeah. So then why do you buy stocks without looking at reviews and setting your own opinion? So it's the same logic that works.
Correct.
And stock research may not be very extensive. The idea is that if you start doing it, eventually you will figure it out. You'll figure out what approach works for you.
And after reading 10 or 2 or many companies, you form your own your own views that what do you have to look in a particular company of this sector, of this group, etc.
Yeah.
Correct. Thanks for being on this show. So this was like a very knowledge-packed episode.
No, thank you. It's my pleasure to be here. And, I wish I was doing half the things that you are doing when I was your age. Looking at you, just one thought comes to my mind very strongly. You have so many years of compounding to go. And you have such a headway ahead of others that... I'm definitely going to look up to you and your research, and it's one of the reading points in my list before I take investing decisions.
Thank you, sir.